During various economic cycles, investors often find themselves puzzled about where to place their money. With numerous predictions for the future, choosing an investment can be challenging. Some suggest buying gold or holding cash, advocating caution due to economic uncertainties. Others advise maintaining the same investment strategy, irrespective of market changes. While volatility is inevitable, accurately predicting future markets is impossible. Certain investments boast a long history of success and are highly likely to perform well in the long run. Could you lose money if the market crashes? Absolutely. However, it's generally safe to assume that select investments will thrive over time. These ETFs are ideal for long-term buying and holding without the need for frequent selling, available from various providers. Stay tuned until the end to discover the type of fund Dave Ramsey recommends for investors. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Warren Buffett advises most people to invest the majority of their wealth in a single fund, the S&P 500. Some might consider allocating nearly all of one's portfolio into one fund as risky and overly concentrated. However, this particular fund comprises over 500 distinct large-cap American firms. Essentially, investing in the S&P 500 means investing in the American economy. Even if current prices seem high, it's challenging to lose money using this investment vehicle over the long term. Moreover, there's a possibility that the market might continue to climb indefinitely without substantial drops. The dividend yield alone is comparable to that of a savings account, currently standing at 2%, despite the market being near an all-time high. The S&P 500 stands out as an excellent investment due to specific criteria and restrictions imposed on its holdings. Each holding must be a U.S. firm with a market capitalization of $5.3 billion or more. The company must consistently report positive profits, especially for the previous 4 quarters, and trade at a reasonable share price. These requirements serve to protect investors. Large blue-chip corporations generally weather storms well and offer consistent dividends. Moreover, you likely use many of these companies' goods and services frequently as they're prevalent. Companies like Alphabet, Johnson & Johnson, Microsoft, Apple, among others, have significant stakes. Vanguard's VUO has notably low fees, although various other companies offer similar options. Investing in the entire stock market or a wide array of companies is another safe approach that can be held without selling. Vanguard's Total Stock Market ETF, BTI, invests in approximately 3,600 different U.S. companies of varying sizes. Apart from large, mature, and reliable stocks, BTI includes numerous smaller holdings that might be unfamiliar to you. This increased exposure to various companies potentially offers greater growth opportunities. Small-cap holdings might be more preferable compared to other funds mentioned, which primarily own companies of similar size. However, many major holdings remain the same. Microsoft, Amazon, Berkshire Hathaway, and Procter & Gamble are among VTI's top holdings. Expected dividend yield of around 2% and a comparable return to the S&P 500, with the primary incentive being added portfolio diversity. Real estate proves to be an excellent investment for various reasons. Investing in a real estate ETF, such as Vanguard's VNQ or a real estate stock, increases exposure to the industry. Shelter remains a perpetual necessity regardless of circumstances, which is why this investment avenue has contributed to creating 90% of the world's millionaires. While the futures of technology, energy, healthcare, and other industries might be less assured for several reasons, real estate remains a constant necessity. Real estate funds invest not only in houses but also in apartments, hospitals, hotels, storage, real estate loans, and almost every other type of real estate. The demand for real estate adds stability in addition to the significant profits paid by real estate investment trusts, REITs. During uncertain economic times, high-yielding equities attract investors. REIT funds typically yield 3% or higher, with Vanguard yielding around 3.5%. It's not recommended to allocate your entire portfolio to real estate, but considering a position can bolster your assets. Another consistently profitable investment is a consumer staples fund. These stocks represent non-discretionary businesses that manufacture necessities. Consider investing in companies that produce laundry detergent, food and beverages, apparel, and household supplies. These businesses thrive regardless of the current economic conditions, and some perform better during tough times. Companies like Walmart benefit as consumers seek savings by shopping at more cost-effective stores. Tobacco and alcohol firms also hold their ground. When times are tough, their sales tend to grow. Companies like Procter & Gamble, Coca-Cola, Constellation Brands, and Walgreens are examples. Purchase BDC from Vanguard for a low cost, or explore similar funds from different companies. An S&P 500 growth fund is ideal for younger investors with more time before accessing their assets. Growth stocks tend to be more volatile, performing worse in declining markets but growing and valuing faster than established income stocks. When the stock market approaches all-time highs, heavily investing in new growth stocks can be riskier than income stocks. However, for young investors with a longer horizon, the potential rewards can be greater. A typical dividend yield for a growth S&P 500 fund is approximately 1% due to reinvesting profits for expansion rather than distributing earnings to shareholders. Nevertheless, you'll receive periodic returns as your investments grow. Remember that each position in growth companies is still a component of the S&P 500, meeting all its requirements, including size and profitability. Dave Ramsey also recommends growth funds, claiming a possible 12% yearly return. Known for his conservative investment approach, Ramsey even suggests cash payments for rental homes. During stock market downturns, the wisest strategy is to continue dollar-cost averaging, investing the same amount regularly. This approach maintains emotional detachment from investments and takes advantage of lower-priced assets. Selling during market declines is one of the worst decisions, as many investors lost approximately half their money during the Great Recession. Subsequently, these same investors remained apprehensive about the stock market and only reinvested after it had largely recovered. Consistent investors greatly benefited during that period. Invest with a long-term mindset, as fretting over the economy in the short term isn't productive. Opt for reliable investments that offer diversification and stability. They've performed well historically and are anticipated to continue doing so in the future. Ultimately, it's not the specific investment that's crucial, but the consistent practice of saving and investing over time. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?